As an experienced tax advisor, I'm going to share 8 easy ways you can avoid paying tax on your crypto. Because crypto transactions are anonymous, investors often think they can hide their crypto profits from HMRC, but that's not the case because HMRC has special powers that allow it to collect investor information from crypto exchanges. So be smart and make sure that you're using these 8 legal strategies to avoid paying tax on your crypto as far as possible. First of all, let's quickly recap how crypto is taxed in the UK. If you're a crypto investor, there are 2 taxes that could apply. The first one is capital gains tax. This tax will apply to most people who invest in crypto when they come on to sell their crypto if they've made a profit on disposal. The second tax that could apply is income tax. This will apply if you receive crypto as employment income, or if you're making an income through mining, transaction confirmation, or airdrops. You'll also be subject to income tax if you are running a business which carries on a financial trade in crypto. But it's very unusual for HMRC to consider that you're trading crypto with enough frequency, organization, and sophistication for it to be a trade. So that would only apply in exceptional circumstances. If you want to understand more about how crypto is taxed in the UK, I will leave a link in the description to HMRC's internal manuals. Now let's cover the 8 strategies that you can use to avoid paying tax on your crypto. The first one is to know your allowances. In the 2025-2026 tax year, you can make a gain of up to £3,000 before you start having to pay capital gains tax. You can also earn up to £12,570 of income before you have to start paying income tax. Most people's income tax allowance will have already been used up through their salary, but lots of people aren't using their capital gains tax allowance of £3,000. So it's important to know that that's there because that feeds into our next strategy, which is to stagger your disposals. If you're planning to sell some crypto, the best thing to do could be to stagger your disposals so that you can make full use of your capital gains tax-free allowance each tax year. Just remember, it's not guaranteed that that allowance will be available every single year. There has been a trend of that allowance decreasing. In 2020-2021, you could make £12,300 of gains before you had to start paying capital gains tax. So it seems like the allowance is reducing, but the government has not made any announcements that that allowance will be reducing anytime soon. So as far as we know, it's still available, so you could consider staggering those disposals. Number 3, make a gift. So again, if you think that you will make a gain of more than £3,000 in the tax year, then you could consider gifting some of your crypto assets to your spouse. That would mean that you could use your capital gains tax-free allowance of £3,000 and you could use your spouse's capital gains tax-free allowance of £3,000 as well. And that would allow you to make a total gain in the tax year of £6,000 before you have to start paying capital gains tax. The gift that you make to your spouse is also free of tax because in the UK you don't pay capital gains tax on assets that you give to your spouse. Number 4 is investing through an ISA. By investing through an ISA, you can access generous tax benefits that can help you to maximize your investment returns. Because when you invest through an ISA, any capital gains that you make on your investments are sheltered from capital gains tax, and any income that you make through your investments is sheltered from income tax. But just remember that, like with all investments, when you invest through a stocks and shares ISA, your capital is at risk and the value of your investments can fall as well as rise. Now, you can't invest directly in crypto through an ISA, but you can invest indirectly. So you could choose to buy shares in a company whose value is linked to crypto, something like Coinbase or PayPal. Or you could choose to invest in an exchange traded product that gives you exposure to a cryptocurrency like Bitcoin without actually having to hold Bitcoin yourself. So you could choose to invest in the iShares Bitcoin Trust, for example. With the capital gains tax allowance now capped at £3,000, like we just spoke about, the ISA is an important tool for investors to grow their wealth tax efficiently. It also means that you don't have to do business on a crypto exchange or incur the costs involved with holding cryptocurrency yourself if that's something that you're trying to avoid. Next, realize losses. Making a loss is never the aim and it's never a good thing, but if you have sold an asset and made a loss because you've sold it for less than you bought it for, then it's important that you claim that loss for tax purposes. You would do that by claiming it on your self-assessment tax return, or if you don't complete a self-assessment tax return, then you can write to HMRC to claim that loss. You can claim a loss for up to 4 years after the end of the tax year in which you made the disposal. And it then means that you can carry forward that loss to offset against any future crypto gains that you might make. You can carry forward the loss indefinitely, so it is important that you do claim any losses because, as I said, you can only claim the loss for the previous 4 years. And if you miss it, then you've potentially missed the chance to offset your losses and save tax in the future. Next on the list is to claim all of your costs. When you're disposing of your crypto, make sure you claim all relevant costs to reduce your gain as much as you possibly can. HMRC say that you can deduct certain costs from your gain, like transaction fees or valuation costs and certain other costs, in order to reduce your gain. So make sure that you're mindful of the costs that you're incurring when you're trading crypto and keep a record of them so that in future you can make any gain as low as you possibly can legally. Number 7, take out a crypto loan. If you're in need of cash, rather than selling your crypto, consider borrowing against your crypto instead. That way you avoid a capital gain and you avoid a tax bill. There are risks in doing this because the loan is subject to the price volatility of the underlying crypto. So if the value of your crypto falls, then you might have to provide additional collateral. Number 8, relocate. One of the more extreme things you could do is relocating to a crypto-friendly country, but you could move to somewhere like Dubai, which doesn't impose capital gains tax or income tax, although it does have a 9% business income tax if you are running a business which carries on a financial trade in crypto. Or you could move to somewhere like Switzerland, which doesn't impose capital gains tax on private investors trading in crypto. Although if you are leaving the UK, then you do have to break your residence in the UK, and that's determined by the statutory residence test, which looks at how many ties you have in the UK and how many days you spend in the UK. And there are anti-avoidance rules as well, which mean that you can't leave the UK, make a huge gain in a crypto-friendly country, and then move back because you would be caught by the anti-avoidance legislation. So this is a long-term decision that does require planning, but if you invest heavily in crypto, then it could make sense, like it did for Christian Angermeyer, who moved to Switzerland to avoid crypto tax. I hope you learned something new from this video, and don't forget to consult a tax advisor on your own personal circumstances if you want to carry out any tax planning. Subscribe if you haven't already, and I will see you next time.